Hello students, for our next topic we will analyze how government policies that intervene in markets, how do they affect the market outcomes. And to do this analysis we will use our supply and demand diagram to see how market outcomes change. In this video lecture we will start with price ceilings and price floors and give some examples of each. And then we will analyze how these price controls affect market outcomes. That is, how do they affect the prices in equilibrium and equilibrium quantities. In the next video lecture, we will talk about taxes on goods and services, and we will ask the same questions. How does it affect the market outcomes, and whether there's some difference if the tax is directly imposed on buyers versus sellers. And also we will talk about what is the incidence of this tax. Price controls come in two flavors. Price ceilings are a legal maximum on the price at which a good can be sold. So the price of the good can be lower, but it cannot be higher than this legal maximum. Rent controls are an example of this. Certain cities in the United States have laws that control the legal maximum on the rent. Texas and Houston doesn't have that, but many other states do. Then price controls can take the form of price floors. And a price floor is a legal minimum on the price at which a good can be sold. So the good can be sold for a price that is higher than the legal minimum, but it cannot be lower than the legal minimum. And the typical example of this is minimum wage laws. So hourly wages are a price. Yes, it's the price of labor. So minimum wage laws intend to have a legal minimum on this price of labor, which is the wage. As of 2020, it stands at $7.25 per hour at the federal level. Many states and cities have minimum wages that are actually higher than this, and there are a few exceptions where it's lower in the United States. So how do these price controls affect the market outcomes? How do they affect the equilibrium price and the equilibrium quantities? That's what we want to look at next. So let's start with a concrete example by thinking about the market for apartments. The market for apartments have some demand of consumers and have some supply from sellers. Yes, and remember, the demand comes from households and the supply comes from sellers. And in the supply and demand diagram, we always have prices on the vertical axis and quantities on the horizontal axis. And given this information, let's suppose that the equilibrium price is $800 and the equilibrium quantities associated with this equilibrium price is 300 apartment units. Okay. So far what we have is an equilibrium without price controls. Now suppose that the government imposes a price ceiling of $1,000. What would be the effect of a price ceiling of $1,000 in this market for apartments? So think about it carefully, because a price ceiling, remember what it is, it's a legal maximum. So the prices cannot get any higher than this, but they can certainly get lower. So we see that with a price ceiling of $1,000, there's no effect on the market. Why? Because market forces, what they do is they want the market price to be 800. So a maximum of 1,000 is no problem, right? So even if it was temporarily lower between 1,000 and 800, the market forces will bring the market price to 800. It will never take it higher than 1,000, which is the legal maximum. Yes? So in this situation, we say that a price ceiling that is above the equilibrium price, we say it's not binding. It will have no effect on the market outcomes. However, now suppose that the government sets a price ceiling of $500. Now this one is different, yes? With a price ceiling of $800, market forces want prices to reach 800. If there's a legal maximum on the price of 500, then the price will never, at least not legally, will not be able to get higher than 500. Yes, so it will not reach its equilibrium level of $800. Okay, so this is an example of a binding price ceiling. And the consequence of a binding price ceiling is that it will create a shortage. Why a shortage? Well, look at what happens at a price of $500. At $500, consumers, you and I, we demand 400 apartment units. Okay? From the seller's side, at a price of $500, sellers are not willing to provide 400 units. sellers are only willing to provide 250 units. Okay, so with a price ceiling that is below the equilibrium price, what we observe is that the a price ceiling it's binding and it will cause a shortage. There is more demand than what there is supply. And in this case, with this information, we can quantify that the shortage is of $150, right? So the shortage is the difference of 400 and 250, which is 150, sorry, not $150, 150 apartment units. So price ceilings below the equilibrium are going to be binding and they cause a shortage. So this is something bad, right? Okay, so without the price controls, the equilibrium was this amount here between the two. It was 300 units, if I remember correctly. Now we see that we have fewer apartments than in the equilibrium. And not only we have fewer apartments than the equilibrium, but we also have a higher demand than we had under the equilibrium. So that creates an even larger shortage. So this is one consequence of having binding price ceilings. Now let's think about the short run versus the long run, right? Remember that in the long run, we expect the supply and the demand curve to be more elastic. We expect them to be flatter, right? So if you compare the graph in this slide versus the graph in the previous slide, this one have slightly flatter supply and demand curves. They are not as steep. And look at what is the consequence of that when analyzing a price ceiling that is binding. Okay, we can see here that what happens to the shortage. The shortage is higher in the long run than it was in the short run, yes? Here we see that the difference between the demand versus the supply at the price ceiling of $500, it creates a shortage given by that difference, right? So the 450 minus the 150, it gives a difference of 300 apartment units. So we would expect, so the lesson from this graph is that we would expect shortages to be more pronounced over longer periods of time, right? Without changes, other things the same, right? So without a change in the price ceiling. Since demand and supply, they are more elastic, then the shortage is going to be higher. So thinking about individuals, what we would have is more people looking for apartments than what they can find, yes? Because of this shortage. And take a moment to see how a simple supply and demand diagram allows us to do this analysis, yes? So this two simple upward sloping supply curve and downward sloping demand curve allows us to analyze what would be the effect of the intervention of the government in this market. And also how the elasticities come into play to see how big of an impact it is, right? We can see here yet another application of elasticities to see the impact of shortages, of the impact of price ceilings, their effect on shortages in markets. So remember what the price mechanism is. So in words, what markets do is that they adjust prices such that consumers and producers can make decisions about how much to supply and demand in the market, right? So the price mechanism without government intervention works as a rationing system, yes? Okay, we saw that when prices were lower than the equilibrium, then that would force market prices to go up. When prices were above the equilibrium, that would bring prices down. But with these government interventions in markets, in particular with a price ceiling, it doesn't allow markets and it doesn't allow prices to follow its tendency to go up, right? Okay, so what must happen? Somehow this shortage has to be addressed by sellers, yes? So sellers must ration the goods among buyers in some other way rather than the price mechanism. So some rationing mechanisms could end up having long lines, or worse yet, there could be discrimination according to the seller's biases, right? And some of these biases could be quite unfair, yes? So if you think about sellers discriminating against race, gender, or other things, yes, then that would be unfair. So we see that the impact of a price ceiling that it's binding, that is a price ceiling that is below the equilibrium, has an impact of creating a shortage. Fewer quantities are available and used and enjoyed by consumers. And this is something that is not efficient. It is inefficient, right? We have less quantities than it would happen under an equilibrium without government intervention. Now let's move on to think about an example of a price floor. And let's have a concrete example. Let's think about the market for unskilled labor. All right, so there's a market for labor. There is some supply and some demand for labor. Now in this case, the roles are inverted between households and firm. When we think about the market for unskilled labor, or the market for any input actually, the demand for the input here, labor, comes from firms. So here in this analysis, it is firms who demand labor. It is firms who hire and pay for the labor that they use in the production process. The supply side of the market is now households. It is you and me who supply that labor, and we get paid for that labor. Yes, we sell our labor service to firms in markets. So we have, it looks the same. Is the market, it's an upward sloping supply curve and a downward sloping demand curve. And let's think about if they make sense. Yes, so what does a downward sloping demand for labor implies? Well, what it implies is that as labor gets cheaper, then there's a higher demand for labor, right? And let's think about what an upward sloping supply curve implies for the labor market. So an upward sloping supply curve implies that with higher wages, then we would have more workers willing and able to supply labor, right? Okay, and this happens at the intensive margin and the extensive margin. Yeah, so you want people to work more, and also you have more people making the decision to enter in the labor market, right? So for both of those reasons, we see a positive relationship between wages and the quantities supplied. So that said, then it should be quite straightforward to see that there must be some equilibrium price, or equilibrium wage would say, in this market for unskilled labor. And according to the information, we have an equilibrium wage of $6, and let's suppose that this is associated with 500 workers, or you can think about 500 hours of work. It doesn't really matter for our analysis, right? There's an equilibrium quantities and there's an equilibrium wage. Now let's think about how a price floor of $5 affect the labor market. So remember what a price floor is. A price floor is a legal minimum. So the price cannot go any lower than $5, but it can certainly go higher than $5. So with a price floor of $5, then we would see that this price floor, this legal minimum of $5, it's not binding. It has no effect on markets, right? Market forces will market forces will bring the price to be $6, and the government decree doesn't prevent that, right? There's nothing preventing it. There's a legal minimum. It is not a legal maximum, right? Okay, so a price floor that is below the market equilibrium, it is not binding. It has no effect on market outcomes. How about when the price floor is $7.25? So that is the legal minimum wage is $7.25. It could be higher than that, but it cannot be any lower. So with a price floor that is above the equilibrium price, so with a minimum wage of $7.25 versus the equilibrium of $6, then at this point, market forces want that equilibrium wage to be lower than $7.25, but it can't, at least not legally. So what is the consequence of that? Well, let's see what happens. At $7.25, firms want to hire 400 workers, but households, they want to supply 550 workers. Jointly, there are 550 people who want to work, but firms only want to hire 400. So that difference between the two, it represents a surplus of labor, right? There's more people looking for a job than what firms are hiring. Another word for this labor surplus would be involuntary unemployment. These people want work, but they can't find it. So this surplus right here, that's something that it's bad, right? And you can see that, if we go from the equilibrium to a minimum wage, what would happen to employment? Employment would go lower than the equilibrium to 400 in this case, right? right? But two things happen. There's also an increase in the quantities of labor that households are willing and able to provide in the market. So that creates an additional burden here that causes this surplus given by this amount of 150 workers that are looking for a job, right? Of course, this is when we have a binding price floor, and intentionally we're thinking about and we are analyzing the market for unskilled labor, right? If we were thinking about the market for skilled labor, then we probably wouldn't have this, a binding price floor, a binding minimum wage, right? If you think about a market for skilled workers, like for example, doctors or lawyers. So if we think about those markets independently, the minimum wage was probably not going to be binding because the equilibrium is going to be higher than whatever the minimum wage is. So for those reasons, we would expect minimum wages to affect market for unskilled labor, but not the markets for skilled labor, right? For skilled labor, a legal minimum wage should not affect those markets. As a matter of what the literature finds is when you look at teen workers, what we find is that a 10% increase in the minimum wage raises teen unemployment somewhere between 1 to 3% depending on the study. Okay, this is also found, or a similar measurement is found when looking at unemployment in the retail sector or the fast food industry. We also observe these reductions in employment due to increases in the minimum wage. When we look at the overall economy, we do not find a huge impact in employment because most jobs are not close to the minimum wage, right? And for that reason, we don't expect big decreases in employment as a consequence of minimum wages because for most type of labor, it is not binding. A survey was conducted to well-known economies about rent controls. They were asked whether local ordinances that limit rent increases for some rental housing units have had a positive impact over the past 3 decades on the amount and quality of broadly affordable rental housing. So an overwhelming 95% of economists disagree that it had a positive effect on the amount and quality of rental housing that has implemented these rent controls. So there certainly seems to be a great deal of agreement amongst economists about this type of government policies. The survey also asked economists about minimum wages. They were asked if raising the minimum wage gradually to $15 per hour by 2020, it would substantially lower the employment. And what we see here is that there is more disagreement, right? So we see that only a third of economists surveyed categorically agree with the statement that it would reduce employment rate for low-wage workers, right? So there seems to be more disagreement in this regard, and the source of disagreement, it's probably because there doesn't seem to be agreement in the estimates, right? So I gave you a range between 1 and 3%. That's an average or a range of averages, but the truth is that this is a topic that still has ongoing research, and we do not know for sure what are the effects. Okay, so here's an exercise for you to apply these concepts about price controls. Let's think about the market for hotel rooms. And what I want you to do is to see what does a price ceiling of $90, a price floor of $90, and a price floor of $120, what does it do to this market for hotel rooms? So you can use the scale on this graph in order to answer those questions. So you should hit the pause button, get your scratch paper, come up with your own answers, and then you could come back and resume the video in order to see the answers. Okay, we're back here. Part A, a $90 price ceiling. We can see that the equilibrium price without the government intervention is $100. So with a price ceiling of $90, right? Remember, a price ceiling is a legal maximum, so prices cannot go any higher than the price ceiling. So prices cannot get to the equilibrium of $100. So what is the market consequence of this? Well, what's going to happen is that at $90, there's a demand for 120 rooms, whereas the quantities that hotels want to supply is 90 units. So there is a shortage of 30 hotel rooms. with a price ceiling of $90. How about a price floor of $90? So remember, a price floor, it's a legal minimum. So the market price cannot go any lower than the minimum, but it could be higher. So market forces that are driving the price to the equilibrium of $100, there's no obstacle to that, right? So the equilibrium would still be $100 and we will get 100 hotel rooms. We say that a price floor of $90, it's not binding in this market. And in general, price floors that are below the equilibrium will not be binding. However, think about a price floor of $120. With a legal minimum of $120, then prices cannot get any lower than 120. So the market forces that are driving prices to its equilibrium price of 100, it cannot happen legally. So the consequence is that with a legal minimum of $100 per hotel room, then the quantities supplied are 120 units, whereas the quantities demanded are 60 units, for a resulting surplus of 60 hotel rooms. So what would happen here is that you would have all the 60 hotel rooms vacant because of this policy. So is the policy good? It doesn't seem to be good. So what do we make out of this analysis? Well, one of the principles of economics is that markets are usually a good way to organize economic activity. So the market forces of supply and demand, they balance the quantities that consumers demand versus the quantities that sellers want to sell at a price level that they can agree, right? So if we don't have the price mechanism guiding the quantities demanded and the quantities supplied, then we will have some other mechanism that we're probably not going to like, right? We said that we can have some sorts of discrimination, okay? So prices have the crucial job of balancing supply and demand. That is, it has the crucial job of coordinating economic activity. And notice that this coordination is not it doesn't happen centrally, right? So we don't have a government making the decision of what must be the price of the good. It is the market forces, consumers minding their own business, making their own personal decisions, firms minding their own business, making their own decisions, and with this individual decision making, then we get to that outcome that is the equilibrium outcome. When governments intervene, what we have observed here is that in both cases, when we have binding price ceilings or binding price floors, what we observe is that quantities in the market are lower than they would otherwise happen under the equilibrium. And it results in shortages or surpluses, which is something that is not efficient. Another principle of economics is that governments can sometimes improve market outcomes. And it is obvious why governments would want to have price controls. Yes, so when we think about minimum wages, the intention is to improve the quality of life by increasing the income of low wage workers. We want to improve their economic condition, right, and their quality of life. And when we think about rent controls, well, we don't want to create an overwhelming burden, economic burden on individuals because they have to pay for a place to live. So these price controls are well meant, but what we observe here is that it has the unintended consequence of actually hurting those who are trying to help. So if you think about minimum wages, the consequence here is that yes, it increases the earnings of those who keep a job, but at the expense of some workers losing their job, at least in theory, and some empirical evidence suggests that that holds. Yes? So the question is, what government intervention can improve the market outcome that doesn't involve this distortion in the market that hurts others? Well, there are other ways of doing it. The government can provide rent subsidies. Okay, so rather than controlling the price, the government can make a transfer from some members of society to other members of society. So there's a federal program, Section 8 of the Federal Housing Administration, that provides payments for part of the rent to low-income individuals, right? It is mean tested, so there is a threshold. You must be below some level of income in order to qualify to be eligible for that type of program, right? So rent subsidies, they are costly for the government. The government must take money from somewhere else in order to pay for that, but it doesn't create the market distortion that we are observing here. So a rent subsidy would work better than a control on rent prices, as some cities do. The same thing could be said about wages. So instead of controlling the wage rate with a legal minimum, we could have wage subsidies. So individuals, and actually doesn't matter if it's paid directly to individuals or through firms, but if we have wage subsidies, that is a different mechanism that doesn't involve controlling prices, okay? So one type of wage subsidy is what's called the Earned Income Tax Credit, and maybe some of you have applied for the Earned Income Tax Credit, and pretty much the way that the Earned Income Tax Credit is kind of a negative tax. So what do I mean by a negative tax? It means that the government is actually paying you for working rather than you paying the government for work, yes? So whenever you file your taxes, then for each additional dollar that you earn, the government gives you an amount, right? And there's a phase-in schedule for earning money. So the more you work, the higher the benefit from the government, the higher the negative tax from the government, that payment from the government. And there's a phase-out period. So after a threshold level of wages, then this benefit to the tax fighter, it starts declining. So the Earned Income Tax Credits is a different way of addressing the situation of the low income of low wage workers that would not involve a distortion in markets. However, there's no such thing as a free lunch. Rent subsidies or wage subsidies, both of them will require the government to get money, to collect money from somewhere else, right? Okay. But these policies are better than price controls in general. I think that most economists would agree with this.